One thing I've been asked repeatedly is about the fundamentals of the futures markets, especially econometric models of predicting agricultural commodities. And I've always thought it was a strange thing because say you're dealing with the corn market, someone who's a fundamentalist first has to consider how much carryover corn is there from the previous year, and then of course watch the figures that announce how much the planting intentions are going to be for the next year, and of course the expected yield per acre. That's sort of a given. I wouldn't know what it is, and of course that's also a function of how late they get into the fields to plant and so on. And then expectations for export demand and domestic consumption. And all of these factors go into an econometric model that says December 07 corn, which is new crop corn, it's trading right now, but it's not even in the ground yet, that it will be at X price. And I've always wondered how they could do that, given the fact that the other variables are the weather and the insects and geopolitical events that could affect the corn market. I don't think it has that much more of an advantage, if any, than the charts. In fact, I prefer the charts, as you know. I've been around lots of people who were fundamentalists of agricultural commodities, and you have two types. You have the number crunchers who just go through what I described, and then there are the people who have good contacts, and those people who can get a word or two from the large contacts have always been the best fundamentalists that I've ever known. In any event, I've also been asked repeatedly about books, and I've tried to remember. First of all, one of the books that influenced me a great deal was Edwards and McGee, Technical Analysis of Stock Trends. It's a great reference book. Other books that I might have been influenced by, most of it's in the arena of literature. Since I'm a student of world literature, I've always enjoyed reading books about speculation, about manipulation particularly. I guess one of the classics is by Émile Zola. I don't know the name of it in French, but the translated word is money. This is an excellent book. I highly recommend it. Of course, Theodore Dreiser, who wrote An American Tragedy, wrote some nice books about speculation. A book that has influenced me a great deal just in life, but I find things in it that I like in terms of trading. And it really has nothing to do with trading. I mentioned it at dinner one night, and that's Hermann Hesse's Siddhartha, which I think has a great message for traders. One of the things that he said in there, the character said to another character, "The reel of appearances revolves quickly." And I think I must have read the book 6 or 7 times before I noticed that line, and it stuck with me. But it certainly applies to the market. As I read to you from that quote from Mark Douglas, anything can happen. Another thing that I found very interesting was his stressing the difference between seeking and finding. There are people, I encounter them all the time, who say they bought 800 books on the markets. They have a huge library on market analysis. They're constantly seeking. They're not finding their own niche. They're not putting together elements from what they learn. Also, I guess, as an important book for reading about markets, I think Alex's books are certainly important. I think the Market Wizards books are very useful because they're war stories. Very interesting war stories about people who started off and maybe some of them fell right on their face and yet succeeded and rose to the top, only to fall in some cases, go to jail in others. And anyway, we'll go back to the study of springs. I've been talking about springs, and I often find that there is still some difficulty in understanding what is a spring. You know, I draw these lines, and it seems so simple. And then I ask someone to show me a spring on a chart, and they draw a line like we have here on this first chart. They drew a line of support across the line B and across the resistance line across A, and they said, is this a spring? This is not a spring. I don't know what they're looking at, but I had someone that I tutor who sent me this chart and said, this looks like a great spring. And I said, well, it may be a great trade, I don't know, but it's not a spring. He said, well, it went underneath this little notch of support. I said, well, it did indeed. But I want to see some tenure to the line of support, or that being the point from which some kind of rebound developed. And so, although we weren't here long, you can see that from line B there was a serious rally. I mean, these are all little support points, but I wouldn't necessarily consider a break of these as necessarily a spring. Here's a classic look where you have a trading range and the market goes underneath the low and then bobs right back up into the trading range. And I often like to see some evidence of a struggle between the buyers and the sellers. The weak little nick under a low doesn't excite me as a spring. It may turn out to be the greatest turnaround in history, but it probably wouldn't catch my attention. I'm more interested in when there's an obvious struggle going on, as here and reflected in the volume. Because here the market goes lower and there's a lot of volume, and yet the market returns to close well off the low or near the high of that session. When I studied the Wyckoff course offered by the Stock Market Institute, they tried to categorize springs. They put them in different types. It's the search for specificity, which I try to avoid. One of the things they talked about is when a market goes underneath a level of support on high volume, rallies and pulls back to test that support, and the volume diminishes, and preferably the price range is narrow, they call that a number 2 spring. All right. A number 3 spring is when the market went underneath the line of support and there was no real increase in volume, and the market never pulled back for a secondary test, and it just flew away. Then they start talking about number 2.5 spring. And of course, I can show you many times where you have a secondary test on very heavy volume, and so on and so on. They do have one more category that's sort of an interesting thought, a number 1 spring. A number 1 spring is when a market goes underneath the level of support and just keeps going. I don't know where the spring is, but I'm beginning to see why they might say that, because then they can refer to every trading range and every breakdown as a spring. But anyway, I just wanted to get across a little bit more definition of what a spring is. The next chart, I've often shown this to students, and I've said, do you think this is a spring? This price action here on April the 4th, and I don't tell them what year it is, and I don't tell them what stock it is. And I say, do you think that this is a spring? And invariably they say, well, it went underneath the level of support. There was a big effort to break the market, and it recovered to close near the high and above the line of support. And therefore, it's a spring. Well, this is a major sign of weakness. The market was literally killed on this day. This is the biggest down day or any day in the history of the Qs at that time. It was the biggest amount of volume. This is like a mortal wound. This is like a big gash in your arm. This is terrible. Because it came back and recovered, just shows how conditioned everybody was at that time, that when the market got hit hard, it was therefore a buying opportunity. But regardless of the environment, regardless of the name of the stock in the time that it was in. It's the fact that it's so far underneath the level of support. So then the question comes up, well, how do you know how far below a line of support a market can go before it can be considered a spring? And I've never really thought too much about it. I just had a sense of what it was. But I've tried to come up with a guideline. I emphasize the word guideline, not a rule. As soon as I make it a rule, there'll be 18 exceptions. But I'm saying that if the distance, you have a line of support and you have a rally, if the distance from that rally to the low of the alleged spring is 1.5 times the distance of this rally, if it's more than 1.5 times, I don't want to consider it a spring. Well, if it's 1.55, I might. But if we start getting much above 1.5, then I have to think it's just part of a downtrend. It could still be a low. It could still lead to a buying opportunity. But it's not the same as a spring. You see how I framed this trading range? The market was rallying. Actually, the break on this day here was the largest down day ever in the Qs. That was the first warning sign that the wind was changing. But in any event, the market went into this range and went above it. Look at the top bars. Haven't we seen this already a few times? The market goes into new high ground, and where does it close but in the middle? If it's still good, if it's going to absorb its weight, it needs to hold. It needs to keep going. The next day, there's a very narrow range day, no ease of upward movement. The narrow range says the same thing as the low volume. No aggressive buying. If there were aggressive buying, we would have ease of movement. So, as I said yesterday, when a market goes underneath the level of support and the range is narrow and there's no ease of downward movement, we have a spring. Well, it's the same with an upthrust. When you break out above the highs, there's no follow-through and there's no ease of upward movement. Beware. And of course, it broke sharply. Now, we went down into the $70 area, rallied back up to 100 and stayed there until September 2000 in the volatile trading range before continuing lower for 2 years. Any questions right here? Okay. All right, this is a stock logic. Here, I mentioned to you how springs fail in downtrends. And therefore, once you recognize that the trend is turned down, and I think the first evidence that the trend is turned down on this stock would be this wide open price break. If I had shown you the price movement to the left, you would see that there had been nothing like this in this stock. And the big volume that came out on this break. So the market found support. You can see it closed well off the low, and we had a little rally. So you see, this is a little upthrust. The market finds support, rallies, you draw a line under that, the market tries to pull back, we go above it, and we reverse down. This was a great situation for going short. This is really telling you that this spring is most likely going to fail and the market is going to continue lower. And it does with a vengeance. More volume, more ease of downward movement. All of this ease of downward movement and high volume on the breaks is telling you that the sellers are in control. Another trading range forms, and we're trying to spring from this low, and again, you'd see that we went above that, and we failed to hold, and once we failed to hold, the selling just flushed into the market again. Again, we stop and we hold, and there's an attempt to rally. It can't get back up above this horizontal line. And we break under here and try to spring, and there's no oomph. There's no ability to follow through. We had no ease of upward movement. We had ease of upward movement on this day from the low to the high, but after that, we had no more follow through. It's very weak. So what does it do? It goes down again. And again, the market comes down and finds support. And look at the rally. Unable to go. Keeps pumping up and down, but no ability to take off. Can't get back above this horizontal support line. I've drawn this reverse trend line here across these two lows. I've got this downtrend line, and here the market goes lower and it closes on the low. One of the most powerful springs is when the market breaks under a level of support, closes weakly, and there's absolutely no follow through the next day. In fact, it gaps higher. And you see, the next day the market jumped up. It did fall back and close near the low, but look at the volume on that day. Suddenly, we have more volume there than on any up day since we turned down. A change in behavior, although the close was not ideal. The close was back near the low of the day, suggesting that the market would try to pull back again. And when it pulls back again on the next day, is there any ease of downward movement? No. The fact that we have no ease of downward movement and the volume is much less tells us there's no supply. There's no selling pressure. The selling is spent, is exhausted, and the market is poised to rally. And you see that after that we rally, and we're coming back into this congestion, and the market tries to pull back. And this next to last day, it goes underneath the lows of the two previous days, and is there any ease of downward movement? A little narrow range day where it closes back right on the high. But even if it had closed unchanged, it's on the springboard. It is ready to move. You see it gapped up. It went a little higher, not that much. It's been in a big trading range. But that's very typical of what happens after a spring. Any questions about this chart?
So where would you enter?
I would be willing to enter after this second day, this little narrow range day here. If I didn't buy it, I'd certainly enter after this little narrow range day. I would have become very suspicious about this market after the no follow through after June the 12th. And I might have bought that day it gapped up like that. It would have been better if it had rallied back above the high of June the 12th. The higher the better, because it traps everybody who was selling short down here. And you see also the shortening of the downward thrust. We have a low here at 44, it looks like 80, 41, 37, 30, 35, 92, and much less ground right here. And if you had a momentum device, an MACD or an RSI, you probably would have a bullish divergence right here. And that's a nice way to combine what Alex and I do, is to look for springs that are also associated with divergences. All right, let's go to the next chart. I'm going to ask you, how many springs are on this chart? Can you identify any springs? Starting from the left-hand corner, this is not a spring, this is a low. This is a rally and this is a secondary test. But can you show me any springs? Does anybody see any springs? You say you find one? June 2nd, that sounds good. Yeah. Give that man a Cupid doll. May is certainly one. You draw a line of support across this low. Market goes underneath the low. It closes underneath the low. There's nothing outstanding about the volume, but there's absolutely no downward follow-through the next day. The lack of follow-through says, here's the place to make the bet. The trend is up. That helps it, doesn't it? That gives it more probability of being right, being successful. Maybe you weren't there to buy the double bottom or the test of the March low. Or maybe you just missed it. Maybe you didn't see it. It didn't make any sense to you. But here's a way to get in the midst of a trend. All right, someone said July. Absolutely. Now look at this spring. Actually, you see it went underneath the line once and rallied and it failed. And here it breaks underneath the line and it closes near the low. Look at the next day, what happens. Number one, is there any downward follow through? None whatsoever. Notice that the market gaps up. It gaps higher, closes on a strong note above the high of the breakdown day. There's still some selling around because it came back and closed well off the high of that day. That is a spring. You could buy it if you have the nerve. That's all you have to do. Now these springs are not as low a risk sometimes as they are when you're depressed. But it's still a way to get aboard. Instead of buying 1,000 shares, maybe you buy 500. Any other springs on this chart?
August 7th.
August. Actually, the level that we're springing is sort of in here. This is not exactly what I would call a spring, but I just consider it to be a pullback to test this breakout. Another place to find trades is after it breaks out above resistance and pulls back into this vertical area to test it. And when it does, you see the position of the close, and then we fly away. There's two more springs on this chart. One that fails. The market goes underneath the low, and there's no downward follow-through. You're testing this vertical area here where we accelerated up. The next day is a narrow range day. Now, obviously, the higher up we go, some of the probabilities of the spring working, I guess, go down because we're coming closer to the end. But this spring still produced profits. Now, if you're just being automatic about looking at springs, which I don't advise doing, there's another little spring here. If you drew a line under this low right here, you see the market went underneath there, and you could say, well, there was no follow-through, and therefore we might have a spring. But it was very weak, and it couldn't hold, and the market went right back down on this day, suggesting or indicating the spring wasn't going to work, and then we went down more the next day. I think another spring on this chart, coming off the low, we started to meet resistance, we pulled back, we started a trading range briefly, and we went underneath it, and we bobbed back to close on a firm note. And here on the 2 days later, there was another test of that spring where it closed on the low. When it didn't follow through after that, it went right back up. Go long and protect underneath the lows here and see if it won't continue. So I'm trying to show you that you don't have to have a base, a 3-month, a 4-month, a 6-month base with a spring underneath it to complete it. Because many times these long trading ranges are resolved with such a washout. Yes, Jim?
What do you do about stops?
I just put my stops underneath the lows that we made of the decline. That's all I can do. It's the only place I have. If after this reversal here, the market came back and had a serious test of the low, but it held the low. So remember, I'm buying at the danger point where the risk is least. It's much more risky to buy the breakout because then I've got to put my stop this far away, from here to here. I don't know how many points that is. Whereas if I'm buying here, I'm just protecting right underneath there. Remember, it's not what you don't make, it's what you don't lose. The next chart that I want to discuss, it relates to Goldman Sachs. I was looking at this spring on Goldman Sachs. One of my clients asked me, what did I think about buying this spring? And I said, well, looking across the chart, the first thing I saw was that the upward thrust was shortening. From October to November to December, we were making less and less progress. And then I noticed that the sell-off on November the 27th was the largest down day from high to low that I could find in Goldman Sachs. And I think my data goes back to 1991. And then I said, well, look here, December 12th had more volume on this down day than any down day since we turned up from the June low. So I said, these suggest to me that I don't think I want to run in and buy this spring. Although I certainly don't want to be bearish. Why? because this is one of the strongest stocks on the board. I don't think I want to go short the market leader right away. So if we could go and get the more recent edition of this chart, as it unfolded, it evolved to a point that was very recognizable as a stock that was poised to go sharply higher. And I'll show you why. And it has to do with narrow ranges and big volume. Okay, now here was December 22nd, and this was the crazy day, January 3rd, when the Federal Reserve released its last minutes from its previous meeting. And there was a great deal of volatility after the report, after the minutes were released. And I saw that the volume soared on this day, and it was sort of a great indecisive day, closing in the middle, but up on the day and a little closer to the high. But I didn't know what that day meant. But then the next day, look at the narrow range day. In fact, almost all of that day's trading was between the close and the low on January the 3rd. And yet the volume was as big as it was on January the 3rd. And even after that day, I wasn't sure what it meant. I said, well, there's a big effort to take the market down, and certainly there's very little ease of movement, but this volume is so suspicious. But then the next day, the market holds again within the close on the 3rd and above the low on the 3rd of January. And the volume is still very heavy. And I felt then that Goldman Sachs was ready to indeed go much higher again and take out these highs. I mean, this is a pretty big move. It's almost $14. Even a $200 stock, you can buy a couple of hundred shares and make $2,800 or so. It's car fare home. Then the market, it did rally nicely. I drew a line across this high and of course this high. And I saw it come back to this high right here. And there was pretty good volume there. 1, 2, 3, 4, 1, 2. There was heavy volume there too. But I thought, this is absorption. And the market even dipped underneath the low there and then screamed up. Speaking of Goldman Sachs, I think one of my favorite indicators about the market, and Goldman Sachs certainly fits into that category, but it is the broker dealer index, the XBD.X. This was a great indicator last May. The XBD.X peaked in April of '06. The other stock indices moved lower from the April high and then made new highs in May. But the XBD did not follow suit. And I was writing in my weekly stock index reports that I thought that was a sign that the stock market was indeed in trouble at that point. Now, of course, we've been sitting here for weeks absorbing against this high. And look what we've done. I guess that's last week. I think that looks pretty powerful. Obviously, if we fall back under last week's low, then we could revise that assumption. Any questions about what I've been saying here related to the Goldman Sachs chart or this chart? Yes?
Do you have a feeling for what happens next after the bottom, the right-hand side of the
I think we're still going higher. But I still don't see enough things yet that would tell me that the market is ready to cave in. In fact, as I'll discuss probably on Thursday, I think NASDAQ could become the leader. It's the high beta market. It became the leader in August and fueled the incredible rally in the stock indices from the August-July period. Can you put up the stock MSO? That's the next chart. you see that there's a trading range, resistance line A and support line B, and right here, the market broke out above that. And so I saw this little narrow range pullback, and I didn't really wonder, but someone asked me, is this a spring of this low and the market is poised to go higher? And I said, I didn't think so. The reason being, this narrow range day has this much volume. What's the meaning of that? There you go. A lot of effort, very little progress. The narrow spread, no ease of upward movement. Yet, there's tremendous volume. The next day, it erases all of the buying that was here. Then it stabilizes and rallies into a new high ground. The buyers have control. Is there any upward follow through? No. In fact, not only does the market come off, but it goes all the way back down and closes well underneath the low of the breakout day, quote unquote. That's fishy. That makes me think this could be an upthrust on your chart. You don't see it on this chart. So I would be concerned, and it did try to rally again, but you see what's happened. The argument was that this could be absorption, and that this could be a little tiny spring in an absorption area before it went higher. But I didn't think so. All right, let's go to the next one. This is the monthly Dow. You know, the Dow was in a trading range from the high in 1966 when it first hit 1,000. And in that trading range, it did go above 1,000 several times. And there was a severe sell-off in 1974. And from that low, the market went above 1,000 again and then broke down. And here we have August 2002, which obviously is the greatest spring in history. Anyone who could recognize on a monthly chart that the market had sprung and pulled back to test the spring, that could be the beginning, the resolution of a trading range of 16 years duration in equities. They're more significant when you see this behavior on monthly charts than they are in the ephemeral world of a 5-minute chart. This is of a higher degree, and therefore a much more important turning point. So if you want to find some situations that might be good for your grandchildren, get a monthly chart book. All right, let's go over here to the other chart. Now I've shown you how I draw trading ranges, little boxes, and how markets move back and forth within these little ranges. This is Friday, January the 5th. There was a low at A and a high at B. The market came back during the day and there was a level of support at C. I'm looking at just below support lines. They don't necessarily have to be the day's low. In here we had two springs late on Friday the 5th, and both provided a little pop, but not very much. The better situation came on Monday the 8th, where the market opened down and took out Friday's low, a lot of volume at the beginning of the day, and it bobs back up and tests it again later and rallies back up to the top of the previous day's trading range. And so I draw a new trading range after this starts to form, E and F. And lo and behold, the market goes underneath that. And look at the position of the closes. This is a 10-minute chart. The position of the closes are well off the low. What does it mean? There's buying there. There's persistent buying down here. That's why it's closing off the low. Someone doesn't want it to go lower. And they're big enough to stop it. And then we get the pop, the spring, fast and furious. What I also like to do with this is put a little moving average line on it. I've been putting a 5-period moving average line, simple, not modified. And when the spring is occurring in a trough, in a moving average trough, that gives it more thrust, more power. It gives it an added push, just the swing of the numbers in the average. You follow what I mean? You can do it on daily charts too, but it has to be awfully sensitive. But I do put moving averages on daily charts to watch the lift with the spring sometimes.
Could I ask you to take a look at the chart of a stock that actually came up for discussion on Saturday? We had a little meeting of and spectators before the cap, and he sent this recommendation to get F Ford. And I will say his fundamental thing was that they got a new CEO and he's betting on the CEO. But if you wouldn't mind taking a look maybe first at a monthly chart and then a weekly chart.
Let's do it.
Yeah. Thank you.
Sure. Yeah, the low here in 03 was 658. And what's the low over here in 06? 606. So the market indeed has come down and tested the bottom of this trading range that started, you could even go back and say late 02, but say 03. They had this rally and come back to test it. They had a very nice lift off the low, and I suppose this is January, the last bar on the chart. So there was an attempt to test again. I'd say that for the investor who's looking at springs, that this is not a bad idea. It's certainly a low-risk bet, and looks interesting to me. How is it from your perspective?
I love when it takes out the previous low, because that's where all the people who read books put their stops.
You see this steady erosion right here in the first 6 months of 06? That is liquidation. Just steady throwing in of the towel. This dog ain't gonna hunt.
And also that it took, what was it, 6, 7, 8 months in the beginning of 2006 to take it down, and then
And 2
the
months.
down move was unwound in 2 months.
Right. That's
so
very
hard
good.
down, easy up.
Right. I think it's set up. I think it's I'm not talking about an instantaneous screamer up to $14 or $15, but I think it's going to appreciate. And somewhere in here it could catch fire.
Maybe take a look at the weekly chart for a minute.
All right. It's interesting again. You have a high here. You have a low the same week. Draw a horizontal line across that low. The market was driven down below there in a steady manner, and now it's just levitating back up. You know what I mean by levitating? Floating. Just unobtrusive levitation. It's one of my favorite terms. Unobtrusive levitation. It only creates doubt. Nobody believes it because it's unimpressive.
To me, this is also, in addition to everything you said about springs and breakouts and false breakouts, it's also illustration of a fact of how fundamental and technical analysis can work together.
Right.
I mean, it comes in as a fundamental tip, really, of which lots of them come in and they don't work out. But this fundamental tip seems to have a whole lot of technical weight to it.
It does. I'd say for the investor, this is a good trade. He wants to sit through hell and high water. The next chart we've already looked at. Now you see my trading range, between lines A and B. I guess I could draw another line of resistance here, but it doesn't matter. My question to you is, who wants to buy this spring? How many think that this is going to be a spring? And how many don't think it's going to be a spring? Are any of you here interested in this spring? Would you buy it? You would buy it. You would buy it. You would buy it. All right, so we've got some buyers. What's the true range on the breakdown day? It's huge. It's true that it came back and closed above the low, but it's too much volume for me. I can't touch it yet. That would be my reaction. Someone showed me this chart. This is Best Buy, BBY. And I don't think it's broken down. I think it's gone a little lower. Yeah, this is the big hard day. So really, we haven't done that much damage. But at that time, I didn't think that this was a spring. I was suspicious of it enough that there was this great effort. And it did close well off the lower, but I had to think that such an enormous amount of volume made me want to stay away. And if I had seen more evidence of struggle in here, then maybe I would have liked it better. But then you certainly have this stopping volume here, and now it's beginning to look much better, I'd say. Let's go to the next chart. This is IYT. I like this stock, or this ETF, or iShare. I like it. It's an interesting one to watch. It has a lot of good behavior on it. I've set up here two trading ranges, AB with a little spring action at 1, and then C and D with a spring action at 2. Can anyone tell me why the spring at 2 produced more than the spring at 1? There was a huge breakdown here, big effort to go down, and it came back and closed near the high. So we know that there was buying on this day. Yet it didn't follow through, and the market comes down again. But we go underneath the low, and there's no follow through on that breakdown. And because of its proximity to this action here, it says the market has a good chance to spring. And that's what made it outperform the other one. Now, you wouldn't know necessarily that it would happen that way, but you would be looking at the fact that it came down. And also, if you drew this channel with a parallel line, you'd see that we were at the bottom of the channel right down here. What was the clue that the market was turning down here and we did not upthrust this high? What was the clue that the market was turning down? Anybody see any change in behavior that signaled that the market was turning down?
Couldn't break the high.
Couldn't break the high? Well, that's a good clue. But there's something overt on this chart, overtly bearish. On the very first day, not the high, but the next day, that break had the highest amount of volume, supply overcoming demand. The sellers flexing their muscle. It did come back and close well off the low. And you might have seen that day and you would have said to yourself, it better rally. And when it couldn't rally, then you had a much better idea that it was going down. And it went underneath here. Any other question about this chart? All right, let's go to the next one. This is a monthly. Where is the level of support that I'm considering at the right-hand side that we might be springing? There's a line of support on this chart over here on the right-hand side that the market has gone under and looks like it might spring. Can anyone tell me where it is? Right here?
Yeah.
No, right here?
Yeah.
Yeah, that's right. Now remember, this is a monthly chart. Do you think this is going to be a spring that works? Or will it fail? I didn't even put volume on it. Look at the last 3 bars and read it sequentially. What's the message? Up. The first bar, it rallies. The second bar, the second month, they're selling. Is there any downward follow through of any significance? No. It goes right back up. There is a great horizontal line on this chart that helps tell a big story. Does anyone see an important support line on this chart? I would call it an axis line. This lower here. Can you draw that line across the chart?
That's a long way.
It's a long way. All the way across.
Wow.
2 generations.
All right, now, there's also an apex on this chart. If you were to draw a line from here to here, this is the TNX.X, the 10-year yield index. It moves like a price, but it is 10 times the yield on the 10-year note. So you have a price here of $45, that means 4.50%. We went from here to 5.24% in June of 2006. Seeing this apex, seeing where we were along this big axis line, and seeing this little spring right here was very instrumental in saying that interest rates were about to rise. And when I look at this chart, I really don't see how interest rates could do anything over the very, very long term but rise. This looks to me like a massive bottom in interest rates. Again, that doesn't mean this year we're going over 5% yield. I'm not saying that on the 10-year. Let's go to the next chart. Okay, we have support line A. And you see the action at point number 1, where the market goes underneath support and reverses to close near the high and in a potential spring position. And you see that from that point, we did have good ease of upward movement on the next day. How do you evaluate the next 3 days? One day at a time. How do you evaluate the next 3 days? Do you think this is going to produce a spring or not? The next day, the market turns down with a great deal of volume. But then it bobs right back up and looks like it's going to go. But it had to go after that, given the way it broke the day before. And instead, it failed. So this stock did go lower. Today, it's much higher. It's Cisco. But it did go lower. I bring these to your attention because a lot of my clients and a lot of the students who I tutor, they bring charts to me and say, do you think this is a spring? And I said, I didn't think it was a spring. It was at this juncture. All right, we have one more chart for today. All right, here's the line of support. The market goes underneath the line of support, closes near the low. It rallies vigorously back into above the line of support and reverses down on huge volume. But look at the subsequent behavior. There's a world of difference between this chart and Best Buy. What's the difference between this chart and the position that we saw on Best Buy? On Best Buy, it had very heavy volume as it came underneath the trading range. But here we have very heavy volume and we don't make a new low. On the day that this occurred, I wouldn't have touched it with with anything. I mean, I just wouldn't touch it. This high volume breakdown day, coming this close to the low, I would say it's death. We're going lower. But it's the lack of follow-through, the inability of the market to continue lower. On Best Buy, it went underneath the line of support with a day like this. Very, very heavy volume, in other words. And then we move lateral for a few days and try to go down again, and there's no follow-through. It bobs back up. What a low-risk place to buy. And it definitely is a danger point. But it is a good trade. You went up to $5.50 or $6. It's a stock called Plug. P-L-U-G.
Plug power.
Is that it? Plug Power. Yeah, see, it tried to have another spring over here. Now, maybe it's going to do it now. But that spring was over to the left a little more. This is it. There's my line of support. Yeah, that was it. Anyway, you see it did rally. For somebody who's looking for a lower price stock, that was a good situation. Well, anyway, I have more for on Thursday. Okay, enjoyed it.